OD Jacob here. Today we're looking at Advansix in the chemicals industry. 648 million market cap on 788 million enterprise value. For such a small company, I do like to look at insider ownership sometimes. So 3% insider ownership, pretty low. And I mean, it's not terribly low, but I mean, really, you'd prefer anything over 10 million, of course. It says they were incorporated in 2016, but yet they have data back to 2014, so I'm not really sure how that is the case. But it looks like they manufacture and sell poly, polymer resins in the United States and internationally. Growth, pretty much zero. No growth. Return on invested capital, declining. Operating margin, average, high, single digit. Gross margin, low, double digit. So there's really not a lot. It's really just a cost of goods sold type business. Not a whole lot of sales and general admin to sell the product. And shares are going down, so they are repurchasing shares. Balance sheet shows 30 million cash on hand with zero short-term debt, 170 million long-term debt. That 170 million long-term debt in relation to their 5-year average free cash flow. I mean, you have some really high years, really low years, probably averaging out to 60 or 70 million. So that 170 million really is not a whole lot in comparison to that. And use of cash, you're really just looking at a little dividend here, 17 million. Let's say they pay out 60 million. That's less than 30% of their 5-year average free cash flow. And to the dividend, and then you're looking at about 50 to 60% to share repurchases, and then the rest to acquisitions, debt reduction, and such. So that dividend yield, 2.6%, pretty hefty yield for it to only be paying out 30% roughly. So that's pretty positive sign. Let's get to some assumption settings. So, I mean, this might be a no growth business. Let's say they make some acquisitions, they make some devastations. In reality, they don't really grow much. Let's really just do averages there. Share repurchases, 1% would be about 6 million. Offset stock-based compensation, about 14 million. I mean, they could buy back 2% pretty easily using 30% of their 30 to 35% of their 5-year average free cash flow. This is leaving a little bit to that dividend. I don't want to increase it because I'm not increasing the revenue at all, and I think that payout is fine. It leaves about 30 to 35% to go towards reinvesting, making acquisitions to get these types of margins, and then reducing down the debt figure a little bit. So, I mean, really not a sexy business here. I mean, these are not sexy assumptions, and we're saying it needs to fall 40%. That's honestly not terrible, but again, with a business like this, you're really going to want to get it cheap because, I mean, your best bet is just to get advancement in stock price from, I mean, you do get a 2% yield, so that's positive, but then really beyond that, just buying back shares that are hopefully really freaking cheap, and then, um, you know, efficient acquisitions. So we'll see what they end up doing, but for now, still a little bit out of the price range, and I hope you have a great rest of your day. Thanks.